Hi, I'm Michael Yardney and welcome to my regular property market update. It's been a terrible year for property, hasn't it? Well, that's what the media would have you think. But has it really been such a bad year for property? Looking back at the beginning of the year, boy are things different from when they were then, well, aren't they? Most of us came into the new year excited and confident, buoyed by our successful property investments in the previous few years. After all, over the previous year, property values increased by up to 20% in many suburbs of Melbourne, Brisbane, Canberra and Adelaide. Interest rates were rising, but so were rents. Inflation was a bit of a worry at the beginning of the year, and they were talking about the subprime thingy overseas. And then things changed, didn't they? In 2006 and 2007, we had a mini property boom, and even inexperienced investors did well. So did the speculators and the foolhardy. It seems everyone can make money from property at the top of the cycle, but our property cycle's moved on, as it does, and all of a sudden the market conditions changed and inexperienced investors, or those that didn't stick to strong property fundamentals, found themselves in trouble. No surprises there, this happens every cycle. During the boom, I saw many investors break the golden rules of property, and they still did well because the boom carried them along. The worst thing that can happen to a beginning investor is to get it right first time. It leads them to tend to think they know it all and that they're invincible. It means some so-called investors tended to speculate. Others bought in secondary areas because properties look cheap. Many of these investors are now trying to sell off their properties and they're not having much luck. In Australia, property cycles last 7 to 10 years. And it's not because of a period of time, but the cycles are related to socio-economic factors and they're of course interdependent on the broader economic cycle. The shortest phase of the general property cycle is the boom at the end of the cycle, which is then followed by the slump, where property values fall. This is then followed by a period of stabilisation in property values until the upturn stage of the cycle starts. Now, we all love property booms, but the slump phase of the property cycle is also necessary. It's a time for things to catch up. If our property markets would have kept increasing, as they had in the previous 2 years, we'd have been in for an almighty crash. And after number of years of above average growth, we're now in for a couple of years of below average growth. That's the way averages work. It's the same with the recession we're having around the world. We need this phase to clean up the excesses and the fat in industry and in our economies. It's a time of slowing down, of taking stock, of becoming leaner and meaner and getting ready for the next upswing. While it means some companies that are inefficient will no longer be around, that's probably a good thing for our economy. If we're in the slump phase of the property cycle, are there still opportunities for property investors, or will values drop significantly? Now, I'll answer each of these questions in turn. First of all, are there still opportunities? Yes, there are opportunities. It's a buyer's market, and you can only take advantage of the opportunities if you buy. Of course, you can't just buy any property, as you could during the boom. My strategy for this time in the cycle really is to continue what I've been talking about for years, and Pam and I have been doing personally for years. Number one, buy the right property. Buy the sort of property that has an element of scarcity, which will always be appealing to owner-occupiers who push up property prices as well as to tenants. Number two, buy at the right price. Currently, this is below market value, at the type of price that even if property values do drop another 5-10%, and I don't think they will anymore, not in most areas anyway, but buy at the price that you'll be covered if property values do fall a bit. Number three, buy in an area that has always outperformed the averages of the market. And fourthly, only buy the type of property to which you can add value, where you can manufacture some capital growth through renovations or redevelopment. Okay, what about falling property values? Are property values going to drop 20, 30, 40% like some people predict? The property markets across Australia have generally held up pretty well, but they're obviously adjusting to the decreased market sentiment. Sure, the value of some properties have dropped. This has particularly occurred in our more expensive suburbs, where there are more properties for sale and fewer buyers. I think the same will happen in many holiday locations over the summer months. Prices will fall as fewer buyers bid for the many properties on the market. And I see property values falling in some rural locations, but affordable property, particularly in the inner and middle ring suburbs in Melbourne, Sydney and Brisbane, and to a lesser extent Adelaide, are holding their values pretty well. Despite that, the unrealistic prediction of certain celebrity economists that house prices will fall by 30% because housing affordability is an all-time low have been relentlessly recycled in the newspapers. They conveniently forget the fact that house prices are determined by supply as well as demand. Now, by the way, affordability is a demand-side factor. And these people are concluding that prices must fall by some arbitrarily large margin. They shock investors by quoting statistics about the rise in household debt, without acknowledging that debt service ratios have actually remained unchanged thanks to vastly lower real interest rates and the emergence of two-income households and higher real income. In fact, recent analysis by the Reserve Bank of Australia has demonstrated that housing affordability is not at an all-time low, particularly in light of flat property values, rising wages and falling interest rates. Now, with lower petrol prices, the government's incentives and interest rates about 2/3 of what they were 4 months ago, the Reserve Bank explained that the average household has got more real disposable income left over after purchasing a home and servicing a 90% mortgage than at any other time since June 1982. Now, isn't that amazing? Also, despite assumptions of rising unemployment and slowing wages growth, both ANZ and Westpac believe that Australia's disposable income will grow solidly by about 8% or more during the next year. Australia won't have a property crash like America, where they have mortgagee sales and whole estates of vacant properties with a huge oversupply of stock. Here we've got a shortfall of housing. At the same time, we've got increasing demand from a rising population, from strong immigration, as well as demographic changes where we need more dwellings for the same number of people due to lower household size. Neither are we experiencing the mortgagee stress that some commentators are worried about. And in contrast to the United States and Britain, where most loans are fixed for years, about 85% of all Australian mortgages are variable, which means most borrowers are going to benefit immediately from the recent rate cuts. I guess the biggest risk to Australian house prices is a credit squeeze. Yet, unlike the United States and Britain, which have suffered multiple bank failures, there's no evidence of Australian banks denying residential credit. Now, sure, they're looking a bit more carefully at all loan applications, and some loan products that were around a year ago, such as no-doc loans, are no longer available. But while the banks are restricting credit to businesses, they're really still happily lending to home buyers and investors. Today, high-quality borrowers still have no difficulties getting 95% loans. In fact, approval for home loans rose 1.3% in October to the highest level all year. Now, the main reason I believe house prices will rise in the medium term is because of enormous excess demand. Currently, house demand is growing at about 190,000 dwellings a year, compared with housing starts of 145,000 homes each year. For example, building approvals in New South Wales alone are at a 23-year low. This has led to a severe housing shortage. This is why I feel very confident about property values in the medium to long term. One of the things that has held back home buyers and investors this year is confidence. How can you be confident about making such a very expensive property purchase with all the talk in the media about doom and gloom, recessions, depressions? But 2009 has the potential of a very different year. We should get a break from the negative news cycle as we head towards the holiday season. In fact, it's already happening, isn't it? The economic woes of the world are no longer front page news as they were for months. There's a new president in the United States, and the banks and governments of the world are uniting to attempt to bolster the world's economies. Now, imagine how confidence might improve in 2009 and what that could mean to our property markets. I'm looking forward to my holiday overseas with Pam and then to an exciting 2009. I'd like to thank you for watching these market updates regularly, and Pam and I would like to wish you and your family all the best over the festive season and a happy, healthy and prosperous 2009.